Another important consideration is the audit of components. So meaning to say, if you are the auditor of the parent company or the head office company, so you may be also asked to audit the component of the entity such as subsidiary, branch, joint venture, associate, and other entities, so belonging to the group. So in that case, you have to consider that in drafting your engagement letter. So some consideration whether to send a separate engagement letter if you are auditing a group. So meaning to say, do you need to send a separate engagement letter in case you will be auditing the subsidiary of the main company that you will be auditing or the parent company that you will be auditing? So it will depend on whether who appoints the auditor of the component. For example, it's the same audit committee that appointed you as the auditor of the parent who will also appoint the auditor of the subsidiary. So because it may happen that the subsidiary is wholly owned by the company that you will be auditing. So in that case, so it's possible that you will no longer need to send a separate engagement letter. Okay, but if you are appointed by a different set, let's say, of officers of the subsidiary, so who are separate from the officer of the parent company who appointed you, so in that case, you need to send separate engagement letter. So you can also consider the issuance of the report, so whether you will issue a separate report in the audit of the group and audit of the component like a subsidiary. Or legal requirements. It's possible that the component is located in another jurisdiction or another country or region or place, and that place or region require you to send a separate engagement letter, then you have to send a separate engagement letter. So other factors to consider include extent of work by other auditors, degree of ownership by the parent, and degree of independence of the component management from the parent entity, similar to my illustration earlier. So if, for example, the component is being managed by a separate group of officers, then you have to consider sending separate engagement letter to them. So another issue in the engagement letter is about recurring audits. So in recurring audits, what happened is that you are auditor of the previous period and you will be reappointed to audit a new engagement period. So if agreed in the original engagement letter, for example, there is a reference there for further arrangement regarding audit of the succeeding period, that you will be appointed also as the auditor of the succeeding period, then you can use that original engagement letter if it provides agreement as to the audit of the succeeding period. However, there may be a need to send a new engagement letter if the client misunderstands the objective of the audit, so you'll have to remind them. So even if the audit of the succeeding period is covered in the original engagement letter, so you might have to send another engagement letter or new engagement letter if you feel or if you believe that the management misunderstands the objective of the audit at that succeeding point. Or of course, if there are revisions on the terms of audit engagement, there are recent change in ownership, so meaning to say you have agreed to audit the succeeding period of the client, but that agreement was made in the previous or with the previous owner of the entity. So if the entity has a new owner and they also agreed that you will be auditing their succeeding period, then you might need to send a new engagement letter. And finally, usually major changes that could affect the engagement, like change in the size of the client or nature of their business, or change in their legal or regulatory requirement, change in financial reporting framework because that is included in the engagement letter on the part of the scope of the audit, and other change in and other changes related to the reporting requirements. So you have to consider sending new engagement letter. Last part of our discussion is about changes in terms of engagement. So when does this happen? So take note that an auditor, before the completion of an engagement, may be requested by the management or by the client to change the engagement to one which provides a lower level of assurance. So in this case, as auditor, you have to consider first the appropriateness of doing so. So like for example, you are engaged to audit the financial statements of the client, and then later on, you were asked by the client to change the nature of the engagement from audit to review. And remember that audit has a higher level of assurance compared to review, which only offers limited level of assurance. So the question is that, would you accept that change in the terms of the engagement? So there are some possible reasons why the client would ask for such change. So for example, there might be changes in the circumstances or requirements. So let's say the client is asking for a loan from a bank, and then they found an alternative mode of financing wherein, let's say, the bank requires an audit and that the new financing source only requires a review. So that's possible. Another is that the client misunderstood the nature of the engagement. They originally wanted a review, but they didn't know what they were asking for is an audit, let's say, instead of a review. And finally, there might be restriction as to the scope. So let's say the client found out that you as auditors uncovered some misstatements or significant misstatements in their financial statements, and to avoid being given an adverse or qualified opinion or modified opinion, then they wanted to change the nature of the engagement. So in that case, you have to consider these reasons in accepting or rejecting the change. Now, if the change is reasonably justified, or if the reason is acceptable, then the report would be based on the revised terms without any reference to the original engagement. So for example, the reason is based on first and second reason that we have mentioned earlier. Let's say there is a legitimate change on the requirement of the client. So from audit, what is being required is only a review, okay? Or the client really wanted a review, but they did not know the difference between review and audit, and they asked for audit engagement. So if you found out that the reason is justified, then you can change to the new engagement, but you would not refer to the original engagement when you issue your report or communication. The only exception is with respect to agreed upon procedures. So meaning to say that, say there is a change from audit to agreed upon procedure, then you may refer to the procedures that you have performed in audit. So because some of the procedures in agreed upon have the same nature with the procedures that you perform in an audit engagement. Okay, so therefore, you may refer to the original procedures or to the procedures that you have performed in the original engagement, so which is an audit. So when the change is from audit to agreed upon procedures. And then finally, if the reason is unacceptable, not reasonably justified, like for example, the management restricts the scope of the engagement. So because they do not want you to issue modified opinion, then as auditor, you reject the change and continue with the original engagement. So for example, you have to continue with an audit engagement. However, if you are prevented by the client to perform procedures related to the original engagement, then you have to withdraw from the engagement and consider whether there is an obligation to report to other parties, so such as to the board of directors, those charged with governance, or the shareholders. So to summarize the changes in the terms of audit engagement, so again, you have to consider the reason, if acceptable or not. If the reason is acceptable, then you accept the change in the terms of engagement, and therefore you will issue a new engagement letter without reference to the original engagement, except if the new engagement is agreed upon procedure, in which case you may refer to the procedures that you have performed in the previous audit engagement. In case the reason is not acceptable, then you reject the change in the terms of engagement and you continue with the original engagement. But if you are prevented from continuing for the original engagement or with the original engagement, then you have to withdraw and consider whether there are reporting responsibilities to appropriate parties like the board of directors or the audit committee. So that ends our discussion with preliminary engagement activities.